Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, let's go and look at our first example then. And we know the delta on that was about 50. But to be straight up and forward about it, that delta was probably 54 or so. It's not going to be exactly 50. And the reason why, and this is a little bit beyond the scope today, but it has to deal with cost of carries. The cost to carry a stock position will go up. So at the money options, if there's no dividends or anything crazy going on in the stock, usually the call will have a little bit higher delta than the put, implying that things will have a tendency to go up because of carry costs and stuff like that. Okay? But let's just compare apples to apples and keep them both at 50. All right, now I've got another question for you. Let's move the stock again. Notice this button came up here. 50, boom. Great stock picker. Now it's 51. We're still on that 1 day to expiration that we were talking about. But that stock just, boom, went up $1. What's my delta now? What is my 1 day to expiration delta? 90. I'm getting somebody saying 0.9 or 90. 50, 50, so it's 50 again. A little bit. 55, close to 1, Brian shouts out there. And I love these answers that I'm getting. But yeah, it's going to be close to 1. As a matter of fact, the delta is about 0.90, and I think somebody got it exactly. So this delta is 0.90 in this situation. And what's the delta on the 60-day option contract? Well, we already answered it. It's 0.60. Okay. So that 1 day option contract had a huge jump. That jump went from 50 cents up to 90 cents. The 60-day option contract went from 50 cents to 60 cents. So definitely a difference in how the options actually move relative to the movement as expiration approaches. This is why, by the way, this is why we like to buy options, right? This is why we like to buy options. Because, why do you think the at-the-money near-term option usually has the highest volume and the highest open interest? It's mainly because these are the explosive option contracts. They really move when you're looking at an option. Okay, so let's go and look at this on a chart. In this situation, let's look at options on the U.S. dollar to the euro. Now, this was actually this is option contracts that have 7 days remaining and 42 days remaining. So if I look at this underlying strike, the strike was at 70. We had a 70, 72, and 74. Now the strikes are the same, but they're different expirations, July and August. And let's compare the deltas. Here, this option contract is just a little bit out of the money, and it's trading for 34 cents, and we see the delta is at 38. Not quite 50 because we're not quite at the money. But what's really interesting to note is when this option contract is $1.75 in the money, the delta increases to 88. Let's look at it on the August contract, 67. So you get 21 more deltas. And let's go back and look at what we are talking about delta. What is delta? It tells you how much your option should move how much the price of the option should move. Let's go back to the textbook definition. How much the price of the option should move relative to a 1-point movement in the underlying. If we look at that and you think about this, this is going to move 21 cents more than the other option contract, and you paid less for it. $1.75 versus $2.35. You could almost think of it as you're going to order it, since it's going to, relative, this is in theory. Everything is in theory. Don't forget that this is just in theory what we're talking about in the options market, what this option should approximately move. But assuming everything else is equal and only the stock is moving, days to expiration hasn't changed in this, we're looking at an option contract that basically acts like 21 more shares of stock than this option contract. Right? It's going to go up 21 cents more. 21 cents, that means it's like ordering 21 more shares, because each contract represents 100 shares. Okay, now the opposite is true. Let's flip it over and look at this out-of-the-money option contract. Now time is on your side. There's 42 days remaining to expiration, and there's 42 days remaining to expiration, and there's 7 days remaining here. So now time is our friend. We're out of the money by $2.25, so this delta actually is larger on the out-of-the-money August calls than it is on the out-of-the-money July calls. It's going to take a big move in a short period of time for the euro to get up to $74 in a 7-day period. So at the money options, delta is going to be fairly close to 50. As I get deeper in the money, it's going to slowly approach 1, not getting larger than 1, by the way. Delta should not get bigger than 1. Well, if you think about it this way, an option is a derivative. Let's go back to the very first meeting. And the option is a derivative, and it's a derivative of stock price. You should never receive more in movement from an option than you would from buying the underlying outright. So if the underlying, if you owned 100 shares of stock and went up 1 and you made $1 or $100, well, that's the most that you should make on an option contract. I mean, that just, in theory, that makes sense. So highest that delta would be is 1. The lowest delta would be is 0, and we have an option contract that's fairly close to that. This is what they call a lottery ticket, very, very, very cheap delta. Low probability of it ever reaching that 74 strike in 7 days. All right, now the next Greek we've already defined, actually. When we talked about our Greeks, when we talked about delta, we gave a great example of gamma. Gamma is the amount a theoretical options delta will change for a corresponding 1 unit or point change in the price of the underlying security. Gamma is highest for the near-term at-the-money strike and slopes off towards the in and out-of-the-money strikes. Okay, so we just defined this statement right here, we proved. If we went back to, and I'm going to jump back to this slide, what was the gamma here? The gamma in this instance, right, the near-term at-the-money strike had a gamma of 40 cents here. That was a huge gamma. And then eventually it's going to get to 1 and it can't go anymore. Down here, the gamma was only 10 cents. Remember, it's the rate of change of delta. That's what gamma is defined as. All right.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.